Then there are financial crises. So these are pretty interesting. Financial crises have been occurring regularly if you look at a long historical time frame. And this statement might surprise you, but a book came out in 2009, which was the timing was interesting because it was right after we entered recession, the Great Recession, by Reinhardt and Rogoff. I have the reference at the end of this slide set that documented, if you look over something like 800 years of data, which is kind of interesting they had that much data, but they did. You see with a long time frame like that in a sense, financial crises happen all the time. That right there is pretty interesting. So something like every 40, 50 years, there's another financial crisis. Well, in the span of 800 years, that's sort of like saying they happen all the time. The second thing they found is when financial crises occur, this normally causes a macroeconomic recession. That's pretty important. Then they found and documented that recessions that occurred after financial crisis are typically more severe and typically longer lasting. Is anybody listening to this surprised? Just think of the Great Recession, right? A very recent recession precipitated by financial crisis, and it was more severe. It was the most severe post-World War II recession on record, and we still have actually relatively slow growth, even though we're out of the recession, but we still have relatively slow economic growth in the United States economy. Okay, is there a taxonomy? I guess I'll give you the advanced answer, which is a sort of a partial yes. We now know that not all recessions are exactly equal. Is there a consensus on after looking at history? So let's talk about that. So the causes, couple things. We can study business cycles by picking a cycle. And this has been done extensively in macroeconomics, particularly for the two big ones, the Great Depression and the Great Recession. So I'll cover those. Another way you can do this is you can say, well, I'm just going to aggregate data over many, many decades and look at all the little cycles and the big cycles, all the little recessions as well as the larger ones, right? And see what patterns come out of that. So I'll talk about both of those. So I have comments on three particular historical recessions in the United States economy. The first is the Great Depression. This is the big daddy. This is the largest on record so far. Although, if you look at certain parts of the economy, then the Great Recession has things that were worse than the Great Depression. And it's basically housing, right? But if you look at other economic indicators, broad ones including the Great Depression was far worse actually than the Great Recession. So it was a 4-year-long deal from 1929 to 1932. There was a bubble. There was a stock market bubble. There was a lot of euphoria. Moms and pops were getting into the stock market. It was pretty amazing. They ended up with too much leverage. Sounds kind of Austrian, doesn't it? Stocks then crashed. I think it was October 29, 1929 or something, October something, 1929. There was a crisis of confidence. And because of the crisis of confidence, everybody went down to their bank and tried to pull their money. But of course, bank doesn't have that money. They don't have all the cash of all their deposits, right? I think everyone knows this. So the banks started closing doors. And that created a lot of trouble. So we had a very severe macroeconomic recession that was exacerbated by policy mistakes. There was tight money at that time. These days we wouldn't do that. We would open the floodgates with monetary policy, as was done in the Great Recession. Whenever there's a severe recession, the current thinking is to open the floodgates and provide credit. They didn't do that back in 1929 or 30. And they entered into a trade war, so that's bad too. So that made it worse. What are the lessons and responses? Well, one of the things, and I think it's good, is they created the FDIC, which is the Federal Deposit Insurance Corporation. So this entity insures holdings at banks up to a certain amount. I don't remember the number right now, but that's a good thing. So there's insurance out there for deposits. So one of the key things about that is most households aren't going to have deposits at a bank in excess of that amount that they insure. And so when there appears to be a financial crisis or something bad happening with the macroeconomy, the idea behind this is households don't have to feel like their money on deposit at their local bank is in danger. They don't have to go running down to the bank and try to pull their money out, right? They know it's insured. So that's key point there. We found out that leverage is bad. I mean, that's kind of like common sense, but I guess it reiterates common sense, you'd say. And you might not have heard this. What's interesting about a bubble, or what's a pain in the neck about a bubble, perhaps is better. Even if you know there's a bubble, it is virtually impossible to forecast when it'll pop. This will come up again. The 1973 recession is the second recession, historical recession, that I'd like to talk about a little bit. It had a sudden and dramatic oil price rise in late 1973. And it was preceded, since 71 at least, the Fed had been hiking interest rates. Then, in Q3 of 1973, they continued hiking, but they did a more dramatic hike of interest rates. So it had been kind of going like this, and then all of a sudden it just, they accelerated the rate hikes in that time frame. So, lessons and responses. That recession is seen as having both supply and demand shocks. The interest rate hike was a demand shock. So, interest rates go up, firms and households pull back on their spending, right? Because that makes their credit more costly. It was seen as having a supply shock. That's the oil price rising. So, the oil price rising is a supply shock because oil is used as an input for many productive processes, particularly back then. It's a little bit less now as a fraction of total industry in this country, but back then it was a bigger deal. And so what you have, you had a key input to many industries. You had the price dramatically rising, which means, right, with that increased cost, they couldn't produce as much. So it was a contraction in productive output in the country. It was seen as a failure of Keynesian theory. And the reason for this is that the predictions that we talked about a few slides ago about, Congress can step in and spend, and that'll help. It didn't help in this case, because in this case, the oil price shock led to high inflation. And it turns out if we tell Congress to jump in and spend money to help the economy, that's going to make inflation even worse. So many thought that, hey, this Keynesian model that's been it had been so popular up to this time. I haven't said that yet. It suddenly became a little less popular and came under critique at this point. Then there's the Great Recession. This is our recent recession, so most people listening to this lived through it. Some might have been affected by it importantly in their personal lives. So it occurred from December 2007 to June 2009. It was created by a pro-home ownership policy mistake. So interestingly, both Democrats and Republicans jumped on the bandwagon of saying more people should own their homes. And without making what should be a short story too long, too many people bought homes. The credit needed for folks to finance their home, most folks have to finance, right, was too easy, too cheap. And so people who should have remained as renters moved into home ownership. That's the key. So that created a housing bubble. And as you might guess, and a little bit of a broken record here, we have too much leverage again, right? So that's similar to the Great Depression and also harkens to the Austrian theory, right? Then Lehman Brothers failed, and that's when there was a crisis of confidence, as in the case of the Great Depression. And a bank run, although a bank run in the modern economy is a little different than back in 1929. It was more of like a credit run between financial institutions where some of the runs, if you want to call them that, it's electronic trading, right? So it's not somebody running over to, Joe Blow's bank. It's done more electronically in the modern economy. But the the activity that was going on is basically like a bank run. Okay. So lessons and responses. Well, we had the Dodd-Frank legislation, which is designed to bring things down. Maybe, this could be debated, maybe a little bit too much of a straitjacket, but still designed to clamp down on financial market activity. But the last 2 points here, same as with the Great Depression. Leverage is bad. Can't forecast a bubble burst, even when you know there is a bubble. Okay, what can we take away from the two big ones? So what I mean by the two big ones are the Great Depression and the Great Recession. They were both characterized by massive bubbles. Stocks in the case of the Great Depression, housing in the case of the Great Recession. And I would argue that bubbles can be seen as overconfidence in spending, right? So what's interesting here is it's a demand side thing because it's spending, but they spent too much, right? Whereas the Keynesian theory was built to show how a contraction in demand could then amplify in its effect on the entire economy, causing a recession. I find this quite interesting. So, all right. Now I'm going to talk about what has come out of the research, and this is a research program over decades, that is, has looked over many decades of historical United States data and other economies besides the United States. But again, I'm being a little US-centric here. First, recessions are more likely caused by demand contractions than supply contractions. That's what's come out of looking at all the recessions, the big ones, the little ones, everything we can get our hands on. There were some important supply contractions. 73 and 79 are two great examples. Those were both oil price hikes, or sharp oil price rises. And demand contractions are fairly often caused by monetary policy contractions. So monetary policy got out there and credit was restricted or credit was made more expensive. Those kind of go together, so you can use either one. Sometimes, interestingly enough, they were deliberate and sometimes they were accidental. The accidental cases are more pre-World War II, actually. So perhaps less relevant today. Okay, what's the takeaway here? Are business cycles here to stay? Oh yes, they are here to stay. In particular, what I would argue is watch for big bubbles. Going forward, anybody listening to this, you should be watching the economy, you should be watching the financial markets to some extent. Don't look at them every minute, it's a waste of your time, but watch them, and if you think you see a big bubble forming, then say to yourself, okay, how am I positioned relative to that? Am I okay or not? And if I'm not okay, how can I hedge? Or how can I modify my position to take account of that risk? And this might not just, this could impact your personal portfolio, but it might also be related to what you are doing as a household, as a head of household, or as a business person. Here are the references. We'll do supply and demand in the next unit.